Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
For me, and I kind of said to you at some point this week, I said, you know what, Samantha, I'm generally a bull. I think that's why we kind of have a bit of fun too, because we sort of have a bit of a yin and yang. And I'm kind of, I don't want to go fully over to, and I'm not saying you're bearish, because you did call that 61.25 and are up around that range. So you're very good at pivoting. But generally speaking, I'm kind of, yeah, no problem. Strong economy. Everything is going to be fine as long as the storyline is strong. I don't care about not fundamentals, rather. I don't care about metrics and valuations, things like that aren't as important when the story is very strong. This could develop into something that I think is a little bit more durable, because really I think the idea was that after the election, everybody really focused on those strong points. It was regulation, it was tax cuts. They didn't want to think about all this other stuff that was potentially on the horizon, and it's happening. It's finally happening. And then number two, this idea that Trump is so pro stock market that he's got our backs. He's there for us. There's this Trump put. It almost feels like he's kind of abandoning that for lower rates. He wants lower rates, and he's sort of going, well, maybe I don't care about how many things I'm going to break in the meantime. And that's very, very unsettling to markets right now. And we're starting to see a little bit of confidence erosion in the consumer. We're starting to see a little bit of business confidence erosion, a couple surveys that came out, confidence surveys. So there is some signs that dreaded stagflation word might come back into the equation, which would be, of course, persistent inflation, perhaps pushed higher by tariffs and some of the things that are going on, and then slowing growth. So this is something that the market is not going to be, it's going to be more difficult to shrug off. So I'm finally maybe turning to the dark side a little bit, at least from a worry standpoint, and just saying, this is something that, and my job a lot of the time is to really measure the durability of volatility. Try to figure out, okay, is this just a quick blip that we can trade, or is this something that's going to be more with us for a little bit longer? And that's important to know, because that has you completely reevaluate what you're doing, right? You're going to sell the rips instead of buying the dips. You're going to have to flip your brain into a different kind of mode if indeed this becomes that kind of market. So I'm not 100% sold on that, but there's some damage on the charts right now, and definitely fundamentally, metric wise, I mean, there are some problems. I'm looking at some of these inflation numbers. Some of these numbers are concerning.
A few things from that, because I literally just wrote about that yesterday, and I found the quote. So over the past week, the S&P has lost 2.8%, but the high beta index lost 7.6%. The high flyers that we were talking about that did a reversion to the mean, which means in my world, because as anyone who knows, I look at the chase, the swing, and the trend time frame, the hour, the day, and the week, and I'm always measuring the week price action relative to the 10-week EMA close. And that is very, very important, because when it gets too extended, it tends to come back. I call it a reversion to the mean trade. So that's another reason why I'm stalking my growth value rotation, interpret, that chart, because I know that when we start to get a pattern together, this is going to favor one or the other, growth or value. And it did not favor growth. Long story short, high beta lost 7.6%, while the low volatility index gained 2.2%. Now, the other things that I had I'm harping on, because I think it's important as it relates to the backdrop of the macro, because I am growing much more bearish. So this is me toward the end of the year. But again, I'm just going to read it. It's a lot easier. Right now, that consumer confidence report that came out was actually a really big deal. So this was not something that was light as it related to a readout when we had the 10-year drop below 4.35. It actually was my level that I was waiting for on this bond long, right, yen long trade that's been going on since January 14th. So I really had 4.35 as my price target on the 10-year yield, and it dumped below it on that consumer confidence report. That was actually, it plunged. It didn't just fall. The consumer confidence plunged to 98.3 from 105.3. And then you kind of look at the inflation print of what consumers are expecting. They're expecting 6%. So that is 3 times the Fed target. It is also the biggest dump in 3 years. So we've got a situation where job announcements on tariff hits are starting to hit, right? Like Alcoa is saying, we're going to have to lay off 100,000 people. I mean, this is like, People are not really able to model in the impact yet, but the consumer is already nervous. They're already looking ahead going, we don't think there are going to be so many jobs in 6 months. And that's exactly what these surveys are measuring. So CFOs will also start to take note, less hiring. Of course, DOGE is still in full effect, hitting the government sector with not just budget cuts, but also labor shedding. That labor shedding is not just government jobs. For every one employee in the government, there are 3 contractors and related funds that feed into that government.
Right.
This is
good point.
Yeah. So
it's a snowball effect, isn't it? It's a snowball effect. Yeah.
It hasn't started, but when it does start, it typically does not slow. It typically picks up speed. So we're not there. And the irony of this is, even though I'm looking at jobless claims coming in, next Thursday and the following and picking up some speed, which is, of course, another reason why I think non-farm payrolls could be eventful. It's actually the opposite. Non-farm payrolls, when they come out and we see a lower unemployment rate, people are going to be scratching their heads. But the reality is we could have a situation very much where, because of immigration slowdown, for lack of another word, right? Policy intervention has pushed now that flow of labor coming in, national security, all of that. But that means less workers to fill the jobs. So the fact that we have actually a falling labor pool, even if the number of jobs declines, which it is, the labor pool is falling, the unemployment rate could actually still fall, but it doesn't mean that growth is going to expand. In fact, the opposite is very likely. So we're actually going to have more likely an economic slowdown to the end of the year, even if unemployment doesn't trigger higher. So kind of
how much do you think, Samantha? Yeah, that's kind of a funny thing, right? It's almost like the numerator denominator, right? Sometimes, when I look at skew, I'm like, well, what is skew doing? Well, it might be the calls, might be the puts. You have to kind of figure out what's going on under the surface, under the hood there, to get the whole story. What do you think, though, about this idea that ahead of the tariffs, you're going to see a bit of a sort of an artificial bump? People start to pull forward some of those inventories, start to go, my gosh, things are going to start going up. So that maybe gives us almost an illusion that things, at least from a little short-term perspective, that things are okay. Is that fair?
It's already been happening. So, Trump expected to win, and then Trump winning, it has pulled forward a lot of demand, actually, and orders. Over time, what happens is not only do tariffs bump up prices of the imports, but it also creates this shrinking of goods and services that we can consume. Again, that, denominator is in play. But we have got to figure out, I think, first and foremost, what happens with the debt ceiling, and this is actually a bigger issue in the short term. So it's very likely Trump's not afraid of doing a government showdown, and not at all. He's really not afraid of this. So I would not surprise me one bit if we get a shutdown on March 14th. And I've got some reasons behind that I've written up for clients. But the point is, we don't have a lot of risk right now. NVIDIA is going to come out, in a few minutes. But I mean, as it relates to earnings, there's still expected 20% earnings growth between Q2 and end of year. Very unlikely, in my humble opinion, but those fundamentals have not been re-rated yet. So the market is still holding sideways in this tight range since the election. So we're going on 3.5 months. Lots of churn underneath. There's still stuff to buy. We rotated from the high beta into XLP, XLV, and TLT. That worked great. At some point, in lieu of rotation, there will be volatility. And that's why we're coming together to kind of look at those massive VIX calls that came in to revisit. Is that now a situation where everybody's focused on those VIX calls and now we won't have volatility? Is there some type of, I personally think we're still going to get volatility. I mean, just from my analysis, but is there a system for you market makers that actually says once everybody's paying attention to it, it won't happen?
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.